A very good evening, everybody. Welcome to the webinar, Forex Trading for Beginners. I'm Ming Hui, and speaking to us today is Mr. Jun Kit, our very own strategist at Phillip Futures. He'll be sharing with us all you need to get started with Forex trading, including a demo on how you can place your first trade on the very popular Phillip MetaTrader 5 trading platform. Before I pass this on to the speaker, please be reminded that if you have any questions throughout the course of the webinar, you can drop them into the questions box and we will address them during the live Q&A session towards the end. And now, without further ado, let's have Jun Kit speak to us.
Okay, hi, very good evening to everyone, and thank you, Ming Hui, for the introduction. Okay, so my name is Jun Kit, and I'm from Phillip Futures. So I'll be a presenter for tonight's webinar, Forex Trading for Beginners. All right, so we are also very excited to share that for today's webinar, we'll be having a very exclusive promotion just for you who are attending real time right now. All right, so just feel free to stick around towards the end where we'll reveal to you what's in it for you. Okay, before we kickstart into the webinar, it is important to have a disclaimer that whatever that's going to be covered during this webinar is only for educational purpose only. It does not take into account your specific investment objectives as well as your risk appetite. Yeah, so do bear in mind that this is not financial advice and it is only for educational purpose only. All right, if all of us are clear on that, let's move on to the structure of tonight's webinar. So we'll start off with a very brief overview of Forex, followed by some common terminologies in Forex. After that, we'll also be looking at some mechanics of the Forex trading. So once we get a good overview of Forex as a whole, we'll dive in a little bit deeper into some of the fundamental and technical analysis. And at the end of this session, you'll be able to learn how to place a Forex trade on Phillip MT5. Okay, to begin, an introduction to Forex. So before we go inside, let's just point out that the structure of this webinar is really to introduce Forex to a total beginner. So we try to make this as easy to follow as possible. All right, so if you have any questions, feel free to drop them in the Q&A box and we will try our best to respond to you after we've covered the main contents. All right, starting off with what is Forex. So basically, Forex is the abbreviation of foreign exchange, also known as the FX market, right? It is a global marketplace where various national currencies are traded. And Forex is actually defined as the giving of one currency in exchange for another at an agreed rate by both parties. Okay, so Forex market is also actually the largest and the most liquid market in the world, with trillions of dollars changing hands every day. And according to a central bank survey done back in 2019, the daily volume for the Forex market is actually 6.6 trillion. Okay, so 6.6 trillion right now, you may not be able to grasp how huge it is, but let's just put things into perspective. The largest stock exchange, which is the NYSE, the New York Stock Exchange, is only having a daily traded volume of 22.4 billion. So the Forex is way larger than the stock market, and it is in fact the largest financial market in the world. All right. The main players in the Forex market include multinational corporations for imports, exports, institutional investors, governments, as well as retail investors like yourselves. And the Forex market actually operates 24 hours a day for 5 days a week. So basically, it only rests on weekends and on public holiday. Forex is traded on margin. That means when a retail trader goes into a Forex contract, it is a leverage contract. Okay, so for now, some of you may have some questions like how is it possible that it's running on 24 hours a day, 5 days a week, unlike the stock exchange where there's an open timing, there's a closing timing. All right, so to answer this question, we need to understand the difference between something that is exchange traded versus something that is traded over the counter. Right, so exchange versus over the counter. So when we talk about exchange, we are talking exchange traded products. We are talking products like stocks and futures, where people go to a central location, like in the stocks instance, people go to the SGX, Candlesticks, and NYSE to trade stocks, right? So they're only able to trade stocks when the market is open. So when the market closes, there won't be any trading activity. So that is the nature of exchange traded product. Same goes to futures. They go to centralized exchanges like the CBOE, ICE, or CME. On the other hand, the FX is actually run on the over-the-counter market. So essentially it means that it does not have a physical location, nor does it have a central location. You can trade Forex anywhere, anytime, without going to a central location like a stock exchange. So let's just, for example, let's say you're planning to take advantage of the upcoming VTL, the vaccinated traveling. You want to change some foreign currency, you go down to Orchard or some money changer, you change your money there. So that in fact, you have participated in the Forex market already. So yeah, you can sub. So the reason that it's so big is because it spans across the world during different time zones, and it is always open throughout the weekdays. Okay, so touching on this point, right, it is very important also to talk about trading sessions because it is impractical for a particular location to be running 24 hours a day. So there is where there is trading sessions. Normally, the trading day would start with a Sydney session because Sydney, or this area rather, is the first city to start any calendar day. So after Sydney, we will go to a Tokyo session, followed by London session, and lastly we have the New York session. Okay, so after the New York session, then we will go back to the Sydney session. Okay, so basically this is based on the time zone lah. All right. So to put things into a more concrete illustration, so for Sydney session, it actually starts at 5 a.m. in the morning, Singapore time. Okay, so it is the first session to start the day, 5 a.m. all the way through around 3 p.m. in the afternoon. And in the middle, you can see that Tokyo session already starts 8 a.m. in the morning. So it just, one opens after another, and the New York will be the last one to open, and it closes at 5 a.m. Just when it closes, the Sydney takes over. Yeah, so this is the reason that the Forex market is able to run 24 hours a day and 5 days a week. Okay, so now looking at this timetable, you may be thinking, so when should I trade? Like there's so many sessions, what do they actually mean? So normally the best trading time for Forex would be 8 p.m. to 12 a.m. Okay, so this would be the optimal time to trade due to a few reasons. The first reason is because London and New York, these two regions represent the most traded currency pair, which is the euro dollar. Okay, and during this timing, it is also the most volatile due to normally a lot of the price stimulating economic events tend to happen during this timing. Events like the non-farm payroll or the FOMC minutes tend to be published during this time, and therefore it may stir some volatility in the market, and therefore people like to trade during these hours. Okay, and also interesting to note that 70% of all Forex trades happens during this hour or this period rather. Okay, so what are the reasons that people are trading Forex? That what draws them to trade Forex? First is the volatility. So basically, the higher the volatility in something, the higher the chance of you making a profit or loss from trading the currencies. And naturally, also risk management is very important to be profitable in the long term. All right, so volatility. So let's say if you're trading something that the price doesn't even move, so essentially there is no meaning to trade that, right? Because you can't benefit from the volatility. Price don't rise, they don't fall. Okay, so that's volatility as the first reason. Second is due to the leveraged nature of Forex, you can open a large position with a relatively small amount of capital. So in Singapore, Forex are traded from a margin of 5%. So with a 5% margin, effectively you are leveraging your capital by 20 times. Okay, and you have the ability to make high profits with just minimal capital. Next up, it's that you can trade in bi-directional in Forex. All right, it allows you to trade when the market is going up. It allows you to trade when the market is going down. So there is always a chance for you to trade in the Forex market. And lastly, due to the sheer size of the market, there is always a high liquidity at any time. You can buy and sell at a very good price. Okay, so that is a very brief overview of Forex. So next up, we will go on some common terminologies in Forex. So these are the terminologies we need to know. All right, so whenever you look at Forex, they are always quoted in a pair. Always quoted in a pair. It has to be something's worth relative to another currency. All right, so they are normally quoted in 6 alphabets. The first 3 alphabets being the base currency, in this case it's euro, versus the quote currency, which is the dollar, the euro dollar. All right, so let's say when you're longing this currency pair, you're buying this currency pair, you are buying the base currency and selling the quote currency at the same time. Okay, so you're buying euro and selling USD when you long this pair. So the rationale behind such action is that you're hoping for the base currency to appreciate against the quote currency. So the opposite applies when you're trying to short this currency pair. You're selling the euro and you're buying the USD. Okay. So what are the most traded currency pairs? Okay, I guess the first one is not hard to guess, is the US dollar. And actually 80% of all the Forex or all the currency traded is actually the US dollar, around 80%. Okay, the next up is the euro, which makes up about 40% of all the Forex trades done, followed by the Japanese yen, British pound, Australian dollar, Swiss franc, Canadian dollar, and the New Zealand dollar. So these are the 8 most traded currencies in the world. All right, so let's talk about currency pairs. So currency pairs are normally you'll hear people talk about major pairs, minor pairs, and exotic pairs. Okay, so these are the 3 main categorization. But I'd like to share with you there's a subcategory under the major. It's called the commodity pair. So basic commodity pair can also be referred as a major pair. So the majors are made up of euro dollar, the dollar yen, the pound dollar, and the dollar Swiss. And the commodity pairs are the Australian dollars, the Canadian dollars, and the New Zealand dollars versus the US dollars. Okay, so these are the major pairs. So if you look closely, you may be able to point out a similarity between all of them. It is the US dollar. So for major pairs, the US dollar is always the common denominator for a major pair. Okay, so a major pair pairs up the US dollar and 7 of the most traded national currencies that we covered in the previous slide. So that is what makes up a major. All right. So minors also known as the crosses. So essentially they are the cross between the top traded currencies except the US dollar. Okay, so the first you can see the euro pound, the euro yen, the Aussie Swiss. So these are all mix and match between the most traded currency pairs. Okay, moving on to exotic. So these are the less traded ones. Essentially, they are made up of currency from emerging markets or smaller economies. Okay, so yeah, these are the less traded currencies. All right. So for someone who is starting, what currency pair should you be looking at? So in our view, it should be the major pairs due to a few good reasons as well. First of all is because of the volume. So you can always look to buy and sell at a very good price. Okay, and the spread tends to be narrower compared to the exotics. All right, so basically how it works is that the higher the liquidity, the higher the volume, the spread will be lower. Okay, so what is spread? We will talk about it later. Okay, so and there's always someone to buy or sell at any given time. Okay, also another reason that we should look at all this is because at any time you can look up analysis and news on all these major pairs. So for someone who is just starting to learn, there are plenty of information online that you can learn on before you start trading. Okay, so after we have learned how to read a currency pair, let's learn how to read a currency quote. So currencies, they are normally quoted with a bid and ask price, sell and buy. Okay, so there's this bid and there's this ask. I think you guys could recall seeing the 2 prices at the money changer. Okay, oftentimes we are confused what they actually mean. Okay, so what the bid mean, the bid on the left side, what it means is actually the price where you sell the currency pair. So let's say you're trying to sell Euro USD, then you'll be looking at the bid price. Okay, on the other hand, if you're trying to buy the Euro USD, you're looking at the ask price, which is the price where you buy the currency pair. Okay, another way to differentiate is the price that you're buying will always be higher than the price you're selling. So therefore the bid and ask. Okay, I hope that's clear. Next up, it is also very common to hear people talk about pips. So what are pips? Pips simply means the 4th decimal figure on the quote. Okay, and recent years, due to the more competitive spreads are getting lower, we have this 5th decimal point called the pipette or the fractional pip. Okay, because the spread is getting so tight that there's a 5th decimal place. Okay, so what is actually spread? I've been mentioning about spread. So spread is basically the difference between the buy and the sell, the ask price minus the bid price. you have the spread. Okay, so the spread can go as low as 0.6 pips. Okay, so let's talk about lot sizes. What are lot sizes? Okay, Forex is normally traded on the standard amount. Specific amounts are called lots. Okay, so it's actually mean the number of currency that you'll be buying or selling. So there are three lot sizes. The first one is a standard lot, which is 100,000. The second lot size is a mini lot, which is only 10,000. The smallest lot size is a micro lot, which is $1,000. So these three different lots allows people with different starting capital to trade. Let's say you're just starting off, we can always start with a micro lot with only a $1,000 notional value. Okay, so here's a screenshot of the trading platform. So when you input your volume 0.1, it actually means a mini lot lah. Okay, so on the platform it's not a problem. You type in the 0.1 and you'll be able to see how much is the notional value. In this case, it's $10,000, which is a mini lot. So this is lot size. Okay, so those are the very few basic and important terminologies when you're starting to trade in Forex. Okay, so let's move on with some of the mechanics of Forex trading. So in this part, we aim to answer a few questions like how is money made on a Forex trade? Secondly, how much money do you actually need to start trading Forex? And thirdly, what are the costs of trading Forex? Okay, so these 3 points that we'll be discussing on. Firstly, how is money made on Forex? So in this segment, we'll be covering a very simple illustration of a buy-sell scenario. All right, so let's say you are purchasing mini lots of Euro USD at 1.18. Okay, so back to the point that I mentioned just now, when you buy Euro USD, you're buying the base currency. So the cash flow will look something like this. The inflow would be a $10,000, 10,000 euro, okay, because you're buying euro. And to buy that euro, you are buying at the exchange rate 1.18. So you're buying 10,000 euro with 11,800 USD. Okay, so the cash flow is like a positive euro and negative USD. So that's how it works. All right, so let's say 2 weeks down the road, the exchange rate has appreciated to 1.25. Okay, so at this time you're looking to sell. So when you sell, right, you are selling 10,000 euro. But in return for selling, you are receiving 12,500 USD because the exchange rate has now increased. Okay, so you buy at a lower rate and you sell at a higher rate. So that is how the simple calculation of how a profit is made on the Forex transaction. Okay, so how much money do you need to start trading Forex? So I guess this is a question that most of us would have in the beginning, because Forex has the reputation of, you need a lot of money to get started. So let's see if that's actually true. So to talk about that, we need to understand margin. Forex is trading on margin. A margin is the amount that you would have to deposit to take up a trading position. Okay, so the amount is usually just a fraction of the underlying asset value, all right? So the margin is to help to ensure that both parties, the you and the broker, they fulfill the obligation. So both will have to put up the margin payments. Okay. Also, there's this thing called the initial margin, which is the amount required as a deposit when you initiate a position. Okay. And the maintenance margin, which is the amount that is required to maintain in that position. All right. So as I mentioned earlier, Forex in Singapore is traded with 5% margin. Okay, so with 5% margin, let's see how it works on the various lot sizes. On the standard lot, taking the notional value of 100,000 times 5%. So the margin required, or also the initial margin, is $5,000. Okay, so to start trading a standard lot, you would require $5,000 of a margin. Okay, so for a mini lot, do the same calculation, it's $500. And for a micro lot, to trade $1,000 of Forex, you would need, you can only start with $50 initial capital. Yeah, so contrary to popular belief, so you can start trading Forex with as little as $50 lah. Okay. So trading with margin actually creates a leverage effect that allows you to use a small amount of capital to make an investment of a greater value. So therefore, a small price change can also result in a larger profit or loss lah. So it goes both ways. It magnifies your profits. At the same time, it also magnifies your losses. So that's why in the space of Forex or leverage trading, risk management is really important. Okay, we need to be aware that this is a double-edged sword. Okay, so moving on to the cost of trading. So Forex trading on our platform is zero commission. So you don't pay any commission for making a trade. The only two costs that you will incur is the spread and the swap. Okay, so the spread we've talked about it earlier. It is the buy minus the sell. Okay, and what is swap? So this swap, it is not the the derivative that some of you may know. It is not the interest rate swap. So this swap, it means something else. So let me go into that. Okay, so before we highlight the definition of swap, it is good to know that Forex is traded on something called T+2, which is any transactions made on spot Forex or Bullion, they are valued at T+2. That means that when you make a trade today, it will be settled 2 days later. So therefore it is T+2. Okay, on the settlement date, the actual currency will be delivered to the counterparty. So that is the value date or expiry date concept. Okay, so now that we have understood value date, let's go into how this swap will arise when we talk about this. Okay, so let's look at this table. When you trade today on Monday, so naturally your value date will be on Wednesday. It is T+2. So Monday, Tuesday, Wednesday. Wednesday is your value date if you close your trade today. So what happens when you hold your trade until tomorrow? So let's say you're holding your trade past Tuesday. So it can't be that your value date is still Wednesday, right? So there has to be an extension of the value date. Okay, this extension is also called rollover in the world of Forex. Okay, so a rollover would happen if you have your open position that is not closed by 5 a.m. Singapore time. Yeah, which is the end of a trading day, like we mentioned earlier just now in the trading session portion. Okay, right, so that is the rollover. And what is a swap actually? So swap is basically just the interest rates that you would incur when the rollover happens. Okay, it also means that it is the net interest returns that is accumulated on a position that you hold overnight. Okay, so whenever there's a rollover, you'll be charged interest rates. Essentially, that is swap. Okay, so let's have an illustration. So suppose you long Euro USD. So remember that we say Forex trading is leverage. So that means you're borrowing money to trade, right? So essentially, you're borrowing USD to buy Euro. Okay, by borrowing USD, right, you would incur a borrowing cost on the euro dollar. And by holding euro, you will receive interest rates on your holding of the euro. Okay, so basically the swap is the difference between the two different interest rates. Okay, and when you have a positive swap, that means you are gaining from the rollover. And when there is a negative swap, that means you're incurring costs. Okay, so that is swap. So to summarize, Forex trading, there are only two costs. First is the spread. The second one is the swap, which is the interest rate charged to you when you hold a position overnight. Okay, so those are the mechanics of Forex trading. So next up, we will go for an overview of Forex and Forex trading, fundamental analysis and technical analysis. Okay, so the two main portions. So this is what people would do before they enter a trade or to analyze what they want to do with the market. Fundamental analysis, it actually helps us shape our trading decisions based on macroeconomic factors that will affect the supply and demand for the currency. Okay, so the data that people look at is the gross domestic product, the inflation, employment data, interest rates, COVID-19 situation, and etc. Okay, so these are the life events that that affects the economy, that people will be paying very close attention to for their fundamental analysis. So here's a table, an illustration of just a few key events. First of all, we have the gross domestic product, also known as the GDP, inflation. There are many reports, on each of these fundamentals. So we have fundamentals, we have the GDP, inflation, employment. So these are just the fundamentals, but on specific reports, right, actually there are quite a few for each of these fundamentals. So let's say for inflation, one of the more common one is the consumer price index. For employment, we look at the non-farm payroll or the unemployment rate and etc. So there are actually quite a few data that people pay attention to. And also the interest rate would be the interest rate decision issued by the central bank. Okay, so how do all this normally work is that whenever all this data is better than expected, okay, so so when it is better than expected, it tends to be bullish for the particular country's currency. So let's look at the GDP. So a GDP actually indicates the health of a country's economy. So when the country's economy improves, naturally the currency would improve. Okay, so ahead of all this release of data, people look at the expectation and the previous data. So let's say if the actual data come out higher than expected, that means it is outperforming the market consensus, and therefore it tends to have a positive impact on the price. Okay, so this concept applies to this four data that we talk about here. So what if the actual data actually is worse than what people think? Like people are thinking the economy is recovering well, but end up the actual data shows that it is not doing so well. Okay, so that will have a negative impact on the currency. Here's an example captured back in August. So let's look at employment. So non-farm payroll is actually a very important data that people pay attention to monthly. So here is an example of its release in August. Okay, so as you can see, this is the release of the better than expected employment data. So bear in mind, this is Euro USD. So what happens when there's a release of better than expected employment data in the US? So in the US, the employment data is better than expected. That means it is good for the US. Okay, so but now we are looking at Euro USD. So as the USD appreciates, the Euro in relative terms depreciates. Okay, so that's for those who are beginning, this may be a bit hard to grasp, but yeah, that's the concept. The USD appreciates and the Euro depreciates, and therefore you can see the slide of the price here after the release of the non-farm payroll data. Okay, so next up, another event or another macroeconomic event that could affect the price is also the COVID-19, like we experienced last year, or even now, in fact. Okay, so the screenshot here actually is the March of last year. It is really like the peak of uncertainty during the COVID-19. And you can also see the euro dollar actually depreciated a lot. This is because the USD appreciates due to its nature of being a safe haven currency. Okay, so at times of the market uncertainty, people are afraid the USD tends to be stronger. Okay. So right here we can see some of the news headlines. So these are clearly fundamental analysis news. You can see the pair, the price movements linking to a fundamental event. Like from here, you can see the coronavirus. People are afraid of it. That's why the USD appreciates. Okay, next up, we also have the pound. They talk about the COVID-19 and the strength of the pound. Next up, we have the retail sales of the Australian economy versus the currency. So retail sales is also another economic event. So basically, when people are spending money on retail, it means that the economy is doing well. It tends to be bullish for the currency. And lastly, also an example is the Brexit. So all these play a part in affecting the movement of a currency. Okay, so what are the tools that we can use to keep track of all these economic events? There are so many out there. So there's something called the economic calendar, where they lay out to you at what time, what event, will be releasing their data. And you can also tell the priority of this event, how important are they to the particular currency. And also you can see the forecast and previous data. So this screenshot is something that happened. That's why you can see the actual is tabulated. So let's say if you're looking ahead of time, the actual one will be blank and they will be updated real time as the event is published. We can take a look at that later at the platform demonstration. Okay, so this is economic calendar, a tool for you to perform your fundamental analysis. Yeah, as I mentioned earlier, people compare the forecast versus the actual data. All right, so that was the fundamental analysis. And moving on to the second portion, it is the technical analysis. Okay, so this is a very interesting part. Okay, so technical analysis helps us shape our trading decisions using price charts as the main analysis tool, so that we can understand the market sentiments based on historical price movements. And we forecast the future price movements using the past, and therefore to determine the entry and exit points for our trade. Okay, so basically, technical analysis has the assumption that whatever happened in the past tends to repeat in the future. So somehow like the history will tend to repeat itself. Okay, technical analysis. All right, a few basic concepts in technical analysis. The first is candlestick. Second is support and resistance. Thirdly is channels. And fourth is the patterns. Okay, so all these would go hand in hand to beef up your arsenal of technical analysis knowledge. Okay, so a candlestick chart looks something like this. Okay, in case some of you wonder, there are other kind of charts. Also, there's line chart, and this is a candlestick chart, which is a more popularly used chart for technical analysis. Okay, so candlestick, also known as Japanese candlesticks, because I think this was invented by a Japanese. That's why it has its name of a Japanese candlestick. So there is two types. There are two types: a bullish candlestick and also the bearish candlestick. So I think as the color suggests or the name suggests, a bullish candlestick, which is green, means that price actually increased. That's why it's bullish. And on the other hand, bearish candlestick, it's red, right? That means it fell in value. Okay, so candlestick can be in a form of different time frame. Okay, so you can have a candlestick on a weekly chart, daily chart, and also hourly chart. So let's say, so for this illustration, let's take a daily chart as an example. So this is a daily candle. So it basically describes the price movement of that particular asset during the day, during the time frame. Okay, so let's dive deeper into the anatomy of the candlestick. There are three main parts. The first is the body, which is the thick body that you see in the middle. The second part would be the upper wick, and the third part would be the lower wick. Okay, the body, upper wick, and lower wick. So what they actually mean? Actually, once you get the hang of it, it's actually pretty intuitive and pretty easy to read. Okay, so for a bullish candlestick, the lower portion of the body means that this was the open price. Okay, open price, and the top wick is the price, the highest price that the asset has reached during this day. So I was talking about daily time frame. So this is a daily chart. So on this day, you know that the price opened at this level, and during the course of the day, it went as high as this, and it also went as low as this. At the end of the day, it closed up above here. Okay, so yeah, I think you guys should get it. Open here during the one day, went up, went as high as here, went as low as here, and eventually closed above. So this is a bullish candlestick. Okay, so the opposite would be a bearish candlestick, can be identified by its red color. So open up here. During the course of the one day, it went up as high as the upper wick, went down as low as the lower wick, and eventually closed lower than the opening price. Okay, so that is a very simple explanation of the Japanese candlestick. So once you get a hang of it, this is really essential and critical for technical analysis. Okay, so candlesticks are also not meant to be used on its own. So it is very powerful to use this to confirm with other things to confirm the sentiment or the price direction. So we're going to share about three popular reversal candlestick patterns. So they're the doji, engulfing, hammer and hanging man. So this three candlestick which I'll cover basically suggests that a trend may reverse. Okay, so a doji, a long leg doji, you can see the wick is very long. So basically you can tell that it opened here. During the time it went up so high, went down so low. Eventually it closed slightly higher, but very close to the opening price. So this normally signals an indecision lah. So the market couldn't decide, oh, so is the price going up or going down? Okay, so this tends to be a bullish reversal pattern. Okay, so and the opposite is the gravestone doji. Okay, so open here, it went up all the way so high, but it didn't sustain. Sellers still came in and it closed even lower than opening price. So this also suggests a bearish reversal lah. Okay, so here's an example of a chart. So I hope you guys are able to identify a few candlestick here. So you see here in the green circle, there are two long leg doji. Okay, and long leg doji, they happen to occur after a downtrend. Okay, so we get one doji, two doji. Okay, that's like a very strong confirmation that it goes up. So after that, there's actually a reversal to the upside. Okay. So another kind of a popular candlestick pattern is the engulfing candles. So there are two types, bullish engulfing and bearish engulfing. So bullish engulfing tends to happen after a downtrend. So after a series of red candles, this bull candle comes back larger than the previous red candle. So it means the buying momentum has picked up and it may suggest a bullish reversal. So the opposite would be the same, would apply for bearish candle, bearish engulfing candle. That means the bearish one is bigger than the green one, and therefore it suggests that price will be reversing to the downside. Okay, another one also is the hammer. Hammer, let's see from here, the screenshot here, a few of the hammers we can see. So hammer, the body is concentrated at the top of the candlestick. So this is a bullish reversal pattern also. We can see we have quite a few here after the downtrend. Then after that, the price rebound to the upside. Okay, here's another example. And hanging man is the opposite version of the hammer. Okay, hanging man suggests bearish reversal. So you see, after an uptrend, when the hanging man comes in, okay, then it tends to have a downtrend lah. Okay, so this is not for certain, but these candlestick patterns definitely have a likelihood of performing the way that they have been said to do. Okay, so we've done with the candlestick. So let's talk about trends. So basically, when you look at a chart, there are a few trends. There are a few types of trends: uptrend, downtrend, and a sideways trend. Okay, so how do you determine or identify this trend? So basically, for an uptrend, right, you try to identify higher highs. So let's say here the high highs. Okay, you see a few that draw a line. High lows, you draw a line. So from here you can see a channel, and it is clearly on an uptrend lah. Okay, so normally the benchmark would be to connect 3 points to validate a trend. So the opposite for downtrend is also the same lah. You connect the low highs and the lower lows. Okay, so support and resistance. People always talk about this. It's really important also. So resistance, it's an imaginary ceiling that price cannot go above. When the price reaches this resistance level, the selling interest tend to arise and the prices will tend to fall. Okay, so let's look at this image here. The price goes up, it hits this level. This is the resistance lah. Okay, so it bounces back off here. So when it's down here, it's met with a support, and support, somehow serves as an imaginary floor that the price just cannot go even lower. So whenever the price comes to this point, the buying power will come in and to send the price higher. Okay, so that is basically resistance and support levels. So what happens when the price hits this support and resistance levels? There are two scenarios. First of all, the price may bounce off from that level. Okay, looking at here, you can see the price went up here. It met with this resistance. What it did was that it bounced off here to come down. Here's a support level. It bounced up. Okay, so this is like conforming to the support and resistance. Okay, so it conforms until it doesn't. So this is the second scenario when the price hits support resistance levels, which is to break it. So at this point, you can see that, oh, the support level is broken. Okay. All right, chart patterns is another very interesting one. Okay, so a few of the popular one is called the rising wedge. So essentially what you're doing here is like you're connecting higher highs and lower lows. So once you connect the two lines, you would find that they are converging to a single point. So that's a wedge, okay? A rising wedge and a falling wedge. How do you trade those? So basically when there's a breakout of this wedge pattern, the benchmark, somehow the target would be set around where the formation started. Okay, somewhere around here. Okay, so that is just chart patterns. So each of these chart patterns they are like not say rules, but they are like rules that say, okay, once it hit this point, normally it should reach a certain target level. So all these are available for you to learn. Okay, so the next one is a head and shoulders pattern. Quite a common one as well. So opposite of head and shoulders would be an inverse head and shoulders. So these are all also a reversal pattern where after an uptrend, you see a head and shoulders, which is identified by a first peak, which is high, the second one higher, and the third one almost as high as the first peak. Okay, so that is a head and shoulders pattern. And price tends to reverse after the price drops below this neckline. Okay, so here's an example of a inverse head and shoulders. You see, it went down here, it displays a head and shoulder, inverse head and shoulder. Once it breaks here, so it really just went up. So this is really a reversal pattern, one of the good examples here. Okay, so what is the difference between fundamental analysis and technical analysis? Fundamental analysis basically is more of like a longer term versus technical analysis, which is shorter term. Fundamental analysis will help us to assess the directional view of the price, and the technical analysis will let us know what is the entry point. Like we want to enter at a support level and we want to exit at a resistance level. Okay, and fundamental analysis tells us what and why. It answers that question, what and why, and technical analysis answers when. When do you enter a trade? Okay, so next up, let's talk about some of the common mistakes and tips for beginner forex traders. The first mistake is not doing your homework. So the tip that we would give is really to read widely to gain knowledge on the fundamental and technical analysis to understand how it actually affects your trade. Okay, so as cliche as it sounds, knowledge is really power. You really need to know what you're doing before you start doing it. It's really like learning how to drive. You need to learn how to drive before you learn how to do the actual thing Okay, so we would strongly advise you to brush up on your knowledge, and a good place to start would be the major pair. Like I mentioned earlier just now, there are abundant of information online that you can look at the analysis to help with your learning. Okay, the second mistake is people taking too much risk. So a general benchmark on that is to not risk more than 1% of your trading capital on a single trade. Okay, so you wouldn't want to risk like a 50% of your entire capital just on one trade. Okay, you want to manage that. And you also need to utilize the risk management tool like the stop loss. Thirdly, is a mistake to not trade with a trading plan. Okay, so you should have a trading plan in mind to outline your trading strategy on which pairs that you want to focus on, want to look at, analyze, what time frame or what session that you want to trade, and also what are the conditions that you want to trade. So let's say a trading strategy can be like, okay, I want to see the certain indicator reaching a certain point in confluence with a chart pattern, let's say a head and shoulders pattern. Okay, yeah, so a few of those things so it has to be laid out in writing so that you are not clouded by emotions when you actually trade. Okay, so another thing also to determine your risk and reward ratio, okay, in trading. Okay, but this is a whole new topic. So due to the interest of time, we will move on. Okay, so coming to the final portion of this webinar, we will be covering a brief walkthrough of our MT5 platform. Okay, so let me hop on to the MT5 platform. Okay, so MT5 is a zero commission forex trading platform. Apart from forex, we also have CFDs. But we're only just talking about forex for today All right, so a brief introduction of this Phillip MetaTrader 5. It is one of the most popularly traded, most popularly used platform for forex trading in the world. Okay, so to walk you through it very simply. Okay, in here you can see this gray space is actually the chart panel. Later I'll put a chart on there, but we would want to start with the menu bar here, where you can see, you can choose different functions. Okay, but okay, let's look at this market watch panel. This is very important because when you come into platform, you want to know where are the contracts, what you can trade. So essentially, this is the market watch panel. It will tell you what are the contracts that you have and the bid and ask price. You can also configure to view different data, like here I've enabled the daily change percentage. Okay, so these are the contracts I have on my watch list. But let's say if you want to view what other contracts are, you can go right click and show all. Show all is a method, and also you can go to symbols. All right, so here you can see the full list of contracts that we have. Forex, these are all the contracts that you are able to trade. CFD, we have different asset classes, commodities, indices, and also have share CFD. So it's really a wide area of asset right here. So this is where so let's say if you're interested to trade all this contract, the Aussie yen, you just double click and it will be added to your market watch panel. Okay, and you'll be able to view the live prices here. Okay, so that is the market watch panel. Moving down here, this is the navigator panel where you will see what is your server, your account is here. Okay, and also some of the indicators is housed under here. The indicators like the RSI, the MACD, they are housed under here. Okay, so down here, it is a toolbox where you can see the trades that you have placed, the history of the trades that you have placed. Okay, and also the news. So the news that we mentioned about just now. In this platform itself, you are able to see different fundamental and technical analysis news here. So it really aids in your different kind of analysis lah. All right. So the news portion, we are powered by FX Street and also Trading Central, some of the more reliable news sources lah. Okay. So mailbox, where you receive daily market updates. Okay. So that is a brief run through. So what happens if you want to see a chart? So basically, let me see. I want to look at the euro dollar. Drag, drop. Okay, so this is my chart. I can choose to go full screen right here. I can choose to expand. Zoom out and zoom in. Okay, so you can get to choose the time frame which you want to look at. So currently we're on 1 hour time frame. You can choose 4 hourly time frame, which means one candle means 4 hours lah. So on a daily time frame, it means a single candle means a daily movement. Okay, so that is the time frame that we get to choose. So let's say if you'd like to play around with the chart, you don't like this color. Okay, so personally, I don't like this color. I get to choose it. I get to choose to change it. Go to properties right here. Sorry, let me repeat that again. On the chart, right click, properties, and you get to choose a few options. So we can go to the colors here to choose, let's say I prefer color on white. This is something that we are familiar with, the bullish and the bearish candlesticks. Okay, right, so this is currently we have loaded our chart. Okay, so let's say if you want to do, you want to look at some, some trading technical indicators. There are a few ways. One of the way is you can go to insert. You can go to indicators, right? Relative strength index. Okay, right. So this is a popular trading tool, which essentially means when it's below the 30 level, it means that it is oversold. And when it's above 70, it means overbought. So there are really many of these technical indicators that you can learn on about and you can play around. So apart from that, you can also, set MACD indicators right here. Okay, so now you know where to find these indicators to pull up your charts. Okay, so let's say if you would like to experiment on some of the line drawing that we went through just now. Okay, so let's maybe look at the weekly chart. Okay, so this is a slightly longer term chart. This is on euro dollar weekly. Essentially, one candlestick summarizes the price movement during that week. Okay, so just to really demonstrate what we went through just now. Okay, so from here, I'm able to identify a chart pattern. I'm not sure if you guys are able to. Right, I'm able to identify a head and shoulders pattern. Okay, right here you can see you draw a neckline here. All right. Okay, so you draw a neckline. So you can see, right, this is the first peak, the shoulder, the first shoulder, the head, and the second shoulder. And what does the head and shoulders mean? It means that it's a reversal pattern, right? And normally the way people determine the target levels for this kind of reversal pattern is to measure the height of the head, right? So let's try to do that. The height of the head right here. Okay. So the rule is like that. So once you break this neckline, which is break this support, it tends to go to as low as how high the head was. So let's see if that's true. Okay. So once it break, you see, we are really on spot. We're really just there. Okay. So from here, you can also see a support and resistance. After you've broken the support, sometimes it tends to go back up to retest, right? To zoom in a little bit. So it broke down from this neckline. It lost its support. So the buyers will try to go up, buy and try to retest this level to see if we can go up higher. But the selling pressure was still so strong, it got rejected from this head and shoulders neckline. And therefore, you can see the slide down here. Okay, so that's one method to use technical analysis, and you can have all that functions in MT5. You know, this is line drawing. You can also, draw Fibonacci levels. This is another trading indicator that's really useful. You can search it up. It's another useful tool in your technical analysis arsenal. Okay, so let's delete that. It's okay. So right, okay, we are here. So let's say you're trying to place a trade. How do you place a trade? Very simple. Up here, you can, so once again, so many things on this platform can be done in various ways. You can place a trade by clicking a order, new order here. Okay, so you'll be able to choose your exchange execution or a pending order. So an exchange execution means you're buying at current price. So whichever the best price is, the platform will match it for you. Okay, so here you're able to input your lot. So let's say this is a mini lot, right? So let's say if I type 1, it's a standard lot, 100,000 euro. So you can also put in your stop loss and take profit here. So let's say if you're looking to buy, or let's say you're looking to sell here, let's say 0.1. Okay, so I'm selling. So after I sell, right, I want to implement my stop loss. How do I do it? Very simple. You can drag from the chart. So once you've entered here, right, you can see that there's a line here, sell. To implement a stop loss, you simply hover over and you drag, right? You can see. So it is quite intuitive in the way that when you're selling, right, when you drag up, it becomes the stop loss. When you drag down, it becomes the take profit. Okay, so I drag up stop loss. I decide to set a stop loss here. Okay, it will ask you if you want to confirm and modify. Yep, I would confirm and modify here. All right, so in the event I want to set a take profit, I just have to pull down to, okay, let's say it reaches this price, it will automatically buy for me to exit the position. Okay, modify. All right, so that is how you can place a trade right here. So once again, all these are just arbitrary trades. They are not, I'm not saying that you should place this trade at this level. It is purely for demonstration. Okay, so right here, right in this toolbox panel, you can see what symbol you have bought into, the ticket number, what time, what type of sell. I chose sell just now, so it's sell, the volume, the price at which I entered the trade at, the stop loss level, and the take profit level. Okay, and at last you can see this is floating profit and loss lah. Okay, so right here you can see there are a few figures, the balance, equity. Right, the difference between the balance and the equity is the balance is the realized profit or loss. Okay, and the equity is the one that is floating. Okay, the equity is floating. Okay, so those are the important ones that you should look at. So how do you close the trade right here? You can just simply click on here to X. There, it will ask if you want to close. You can just close the deal right here. Okay, so I think I've covered the main panels of the Phillip MT5. I've demonstrated how to view the various contracts available here. I've also showed you how to drag and drop the chart into the chart panel right here, and also demonstrated a few trading tools on this platform. Okay, so and I've also demonstrated how to place a trade and close a trade on this platform. Okay, so I think due to the time constraint, that is all for this platform demonstration. Okay, so before we move into Q&A, hold on, let me share my screen. Okay, so you remember just now earlier in the session, I was saying that there's an exclusive promo going on for today's webinar. So yeah, that's real. So for those of you who have waited till now, yes, you have it. So for today only, for those of you who are currently attending and listening to this webinar, you'll be able to receive a $50 trading credit when you open a MT5 account with a minimum funding of $1,000. Okay, so this is only limited to this 24 hours lah. Right? Yeah, you can claim this by scanning the QR code here. So do bear in mind, it's only this QR code that works. If you go to the website, the generic one, it doesn't work. This is only exclusive for those of you who are watching this right now. Okay, and it wouldn't work, if someone is to watch the replay of this webinar, it doesn't work anymore. All right, so $50 trading credits for the first 24 hours if you open an account. Okay, so I think that is all of my sharing for tonight. I hope that was fruitful, and I really hope you get to take away something from tonight's sharing. All right, so I think before we go, may I ask my moderator Ming Hui, do we have any questions?
Yes, we do have questions. Would you like me to read them out to you, or?
Oh, okay, I'm reading here. Okay, so I'm seeing one question here is, what platform is the on what device is the MT5 available? Okay, so basically we are available on MT5 desktop and also on mobile. So we have both mobile and the desktop version. Okay, and also for the desktop, right, there's MT5 for both Windows and also for Mac. Okay, let's see what else we have. Oh, what is the difference between Nova and MT5? The difference is actually Nova is a proprietary platform which enables trading of different products. So Nova, we're talking about futures. We also do have Forex. And on Nova, there is shares, like cash shares. But for MT5, it is only for leverage products, derivatives like Forex and CFDs. Okay. Yeah, so those are the two main big differences. So depending on what kind of product you're looking to trade, you'll be indicating interest for different products. Okay, so will you be entitled to $50 if you already have a Nova account? Oh, apologies, this is only for first time account opening. Yeah, so it's only entitled for those people who are opening a account for the first time. Okay, apologies, I do see quite a few questions, but unfortunately due to the time constraint, we have to get back to you via email. Okay, so be rest assured that we will get back to you, to your answers, to your questions via email. Yeah, and really thank you very much for your time, and see you guys soon. Right, back to you, Ming Hui. Thank you. Thank you, everyone.
All right. Great. Thank you, Jun Kit. We shall end tonight's session here. And as mentioned, the questions we couldn't get to tonight, we will respond to them via email. And this was a very insightful session. So thank you again, Jun Kit, and thank you very much, everybody, for your time tuning into this webinar tonight. We'll be sending everyone a link to today's webinar recording so you can watch it again if you'd like to. That's all for today. Thank you, everyone, and goodbye.